Let's have a look what we have covered so far. The first video showed a very basic explanation of the concept of exchange-traded options. In the second video, we saw how that concept can be applied and what it means in the stock market, and I showed that via a call option. And now, third video, let's have a look what call options and what put options especially are. In order to do that, let's go back to the definition of an option again, but by now we should almost know it by heart. In finance, an option is a contract. We know that, which gives the buyer the right but not the obligation. We know that too. To buy or sell an underlying asset or instrument at a specified strike price on or before a specified date, which is the expiry date. So far, there's nothing new. However, we have only focused on the right to buy an underlying asset. In the early case, it was the umbrellas or the BHP underlying share. Let's have a look what this means. What if we have an option that gives us the right to sell an underlying asset? So here is the infamous BHP stock chart again. Let's assume today's date, and BHP is trading at about $34.50, and for whatever reason you think, you know what, this is not gonna go any further up. I think the stock will fall. And you're trying to make some money out of the falling stock price. So how can you do that? Are you gonna buy shares? Well, that doesn't make any sense. If you think that the stock price is about to fall, you're not gonna buy shares. So no, that's a no. To be precise, you could of course short them, but that is a different ballgame, and I'm not explaining this here. What we can, however, do, we can buy a put option, because a put option gives us the right to sell 100 shares. Remember, the call option gave us the right to buy 100 shares. So in this case, we buy a put option, and that gives us the right to sell 100 shares for $34.50 each. We want the deal to be valid again for 1 month, which is here at the red line. And that will cost us about 60 cents per share. For the 100 shares, that would be $60. Well, a month later, great. The stock has fallen, trading at about $31.40. So what are we going to do? We exercise our option. The 100 shares in the market, we can buy them for $3,140. We have the right to sell them for $34.50 each. That's $3,450. So if you subtract the two from each other, that's a $310 profit, minus the $60 that you've paid for the option, and you keep the profit of $250, or 317% of the money that you have invested. Let me make sure that we understand what went on here. At some point, we took the view that the stock price is going to fall. We paid 60 cents for the option, so that makes our break-even point 60 cents lower than the share is currently trading. So the stock actually has to fall by these 60 cents for us to be able to make money. Down there is our profit. Up there, if the stock price goes up there, it's our loss. Any time between the start and the expiry, as long as the stock keeps falling, we can do something with our option. We can exercise it, or we can sell the option, and we are making money, and we're making good money in this case. Now, timing is everything with options, and let me just give you the following example here. Say we would have bought an option with an expiry date not 1 month but 2 months out. So that moves the expiry over here. And we buy it at the green line, and all goes well for the first couple of weeks, and the stock falls. We're laughing because we're making lots of money. We're thinking, oh, this is just awesome. I'm gonna hold on. Then the stock starts rising, and we could be watching our profits just disappear. And if you're not careful, this tremendous profit that you were sitting on, in fact, can completely disappear if you don't get the timing right. It is really hard to explain what kind of emotional roller coaster it is to see profits like that come and go. I'm not going to get into it here. For the moment, just remember and be aware that timing in options is extremely important. All good, and time for a recap. Very early, we learned call options give you the right to buy an underlying asset. So the owner of a call option obtains the right to buy an underlying asset. The owner of a put option, on the other hand, obtains the right to sell an underlying asset. So the owner of a put option in the stock market obtains the right to sell shares at a specified price. Mind you, you don't even have to own those shares in order for you to obtain the right to sell them to someone. You also don't have to worry about the fact that you would have to go and buy those shares and then on-sell them to someone. That is all done without any capital outlay by your broker. All you have to come up with is the money to buy the option. Just think about it this way. A call option increases in value, and you will make money with a call option when the underlying stock increases in value. And a put option, you will make money. A put option increases in value when the underlying stock decreases. Neither one of them, the owner of a call or the owner of a put option, they have no obligations. You have the right to buy or you have the right to sell an underlying asset, but you do not have to do that. There is no obligation for the owner of an option. We learned that potential gains for call options are in fact unlimited. Okay, that's a very theoretical thing to say, because in theory you could buy a call option and between the buy and the expiry date, the stock in theory could reach unlimited heights. As a result of that, your potential gains are of course unlimited. Well, potential gains on a put option are limited because the best thing in this case the best thing for the owner of a put option is that the company goes bankrupt in the next few weeks. But still, even if the stock price falls to zero, your gains are going to be tremendous, but they're not unlimited. Never mind about this. I don't know why people always mention that. Losses, on the other hand, in both the call options and the put options are limited. You can never lose more money than you have paid for the option premium as long as you're the owner of the option. Both options have a very limited time frame for you to make money. Time is of the essence in options trading. I can't stress that enough, and in the next couple of videos we will learn much more about this. Do not underestimate how important time and time frames are in options trading. That's it for the video on put options. If you liked it, by all means keep watching or contact me if you have any questions or suggestions for other videos. For more, check out my website at Gutrade.